Welcome to the Deep Dive, where we cut through the noise to bring you the most important insights from earnings calls. Today, we're doing a deep dive into Kimberly Clark's latest earnings report. The company behind a lot of household staples. Our goal is simple. Break down their recent call, figure out what the key takeaways are for their performance, their strategy, basically what you need to know without digging through the whole transcript yourself.
Yeah, and this quarter's call, it really did offer some compelling signals about where they're heading strategically, market performance. It set a pretty positive tone, actually.
It definitely caught the market's eye. So with that positive tone, let's jump right into the numbers that grabbed attention. What stood out? Okay, first up, Kimberly Clark reported non-GAAP adjusted EPS of $1.92. That smashed the consensus estimate of $1.67.
Right, a 15% beat. That's pretty remarkable.
It really is. And for listeners, maybe just a quick refresher on non-GAAP adjusted EPS. Why is that the number we often focus on here?
Sure. Basically, it strips out certain unusual items. Things like, big restructuring costs or maybe gains from selling off a business. So it aims to give you a cleaner look at the company's, let's say, core operational profitability for the quarter, how the actual ongoing business is doing.
Right. Gets rid of the noise. Makes sense. Okay, so that was the earnings side. But revenue, that was a bit of a different story.
It was. Reported revenue came in at $4.16 billion. That actually missed the consensus of $4.47 billion, so about a 7% miss there. But, and this is important, the organic sales growth tells a much better story. That was up 3.9%.
Okay, organic sales growth versus overall revenue. Why do we care about that distinction, especially for a company like KC?
Yeah, good question. Organic growth takes out the effects of things like buying or selling businesses and, crucially, currency swings. So it shows you how the existing business grew, just from selling more stuff or maybe getting better prices. It's a much better indicator of the underlying demand for their brands, especially with all their recent portfolio changes.
Got it. Core performance. And the number that really jumped out, I think, for a lot of people was volume growth. Hit plus 5% this quarter.
Yeah, their best performance on volume in 5 years.
Incredible. And that strong volume plus the EPS beat, well, the market definitely liked it. Shares jumped pre-market, closed up, trading volume spiked.
Saw some bullish options activity, too. It resonated.
It really did. That 5% volume growth, though, especially now, consumers were watching their wallets. It almost feels counterintuitive. What's the strategic thinking behind that? How does it link to their powering care strategy?
Okay, so this is where it gets interesting. That volume growth, it ties directly into powering care. Management kept talking about cascading premium features into value tiers.
It's cascading premium features. But what does that mean in practice? Like better diapers, but not at the top price point.
Exactly. Or maybe some feature from their premium wipes showing up in the mid-tier or value tier product. The key insight here is Casey is deliberately choosing to chase market share through offering better value, even if it means, nominal prices might dip a bit.
So less focused on just hiking prices, more on winning volume with better products at accessible prices.
Precisely. They're betting that loyalty and volume will pay off long term, especially as inflation maybe cools off and people are still very value conscious. It's actually quite different from some competitors who've been very price-led.
That's a really interesting strategic contrast. It feels like they're trying to meet the consumer where they are right now.
Yeah, I think that's a good way to put it.
Okay, and speaking of strategy, we absolutely have to talk about the big portfolio shift. That June agreement to sell a majority stake in their international tissue business to Suzano. $3.4 billion deal.
Right, the elephant in the room.
How does this reshape Kimberly Clark going forward? And are there, risks involved in such a big move?
Well, connecting it to the bigger picture, it's fundamentally about streamlining. They're shedding a segment that was, frankly, lower margin and maybe lower growth.
In the international tissue part.
Exactly. To really sharpen their focus on the higher margin core stuff. Think premium diapers, adult incontinence products, their main branded tissues, areas where they're already number 1 or number 2 in the market.
So freeing up cash and maybe just as importantly, management attention.
Yes, precisely. Management bandwidth is huge. This lets them laser focus on North America and their international personal care business, which have better growth and margin profiles. And it should help them get towards those long-term margin goals, 40% gross margin, 18-20% operating margin by 2030, maybe even faster now.
That's the ambition. But playing devil's advocate, any downside to selling off a big chunk of international tissue? Less diversification, maybe. More reliance on fewer categories.
That's fair. I mean, it does reduce some geographic spread in tissue, obviously. But the thinking is They're exiting a tougher, more capital-hungry business to reinvest in areas with genuinely better returns. The risk, like with any big divestiture, is always execution, right? Making the transition smooth. But management seems pretty confident, and the market reaction kind of suggests investors buy into the focus story.
Okay, so a leaner, more focused KC emerges. What does this mean for their outlook? And how does the CEO, Mike Hsu, see the consumer environment right now?
Yeah, CSU acknowledged, consumer wallets are still stretched. He said he doesn't really see a quick fix for that changing anytime soon.
But realism about the consumer.
Right. But he strongly emphasized that KC's categories, diapers, wipes, tissues, they're essential. People need them. There aren't many easy substitutes. So that leads to what he called resilient demand and durable growth.
Right.
But it does raise that key question, doesn't it? How do you keep winning, even in essential categories, when consumers are under pressure and looking hard at value?
That really is the core question. Because essential doesn't mean consumers won't shop around within the category. Are they just eating costs? Or are they genuinely innovating, like you said, to keep people buying their brands, even if they're price sensitive?
It seems like the latter is the focus with that cascading features idea.
Okay. And on that note, they did raise their outlook for 2025. What are the specifics there?
Right. For 2025, they now expect organic sales growth to actually beat the category growth rate. And for their now more focused business, North America and international personal care, the category is growing around 2%. So Casey is aiming higher than that.
Okay, outpacing the market.
Yeah. And they're also projecting low to mid single-digit growth for adjusted operating profit and EPS on a constant currency basis.
What's driving that improved outlook?
Well, partly it's a lower hit from tariffs than they first thought. They now expect a net impact of around $170 million gross, which is $130 million less than the old estimate. And they think they can offset about $50 million of that anyway.
So less headwind from tariffs.
Exactly. And another sort of technical tailwind is pausing depreciation and amortization on the businesses being sold off the discontinued operations. That alone adds about 16 cents to full year EPS.
Okay. So a mix of macro improvements and accounting effects from the divestiture. They also talked about productivity gains, SG&A savings too.
They did. Really strong in productivity. They hit about 5.5% gross savings in the first half, ramped up to 5.8% in Q2 alone. They're aiming for the high end of their 5 to 6% range for the year now.
That's significant savings.
It is. And they're also well on track for $200 million in run rate SG&A savings. But it's not just cutting, It's also interesting is their renewed push on marketing.
Oh, yeah. What are they doing differently?
They're building up more creative capability in-house, and they're trying to move beyond just talking about technical features. They want to build more of an emotional connection, as they put it.
Emotional connection for diapers and tissues.
Sounds a bit funny, maybe, but it seems to be working. Look at their performance at the Cannes Lions Advertising Awards. They doubled their total awards from the last 5 years, combined just this year alone.
Wow.
Yeah. And you probably remember that viral poop poncho ad.
Oh, yeah, the poop poncho. I do remember that.
Well, that's a perfect example of this new creative approach. A bit playful, definitely memorable, cuts through the usual category noise, shows they're willing to be a bit bolder.
Okay, that definitely paints a picture of a company trying to operate differently than maybe a typical staples giant. So how does this whole approach the volume focus, the value innovation, the new marketing vibe, how does that position KC versus its peers? The P&Gs, the Cloroxes, who maybe seem more price-focused traditionally.
Well, that's the big question for investors, isn't it? How will KC stack up? Their strategy, pushing innovation down into value tiers, using more engaging marketing. It could be a real competitive edge, especially if inflation keeps cooling and consumers stay cautious.
Because peers relying just on price might face more pushback or need more promotions.
Exactly. KC might be better positioned to actually gain share and appeal more broadly, while others could get caught in heavier promotional battles. And the fact the market rewarded the EPS beat, even with the revenue miss, it kind of signals growing confidence in this whole turnaround story. Like the market's starting to believe this value-driven approach can work long-term.
So a potential shift in perception there. Given all this, what are the key things we should be watching for, catalysts or checkpoints in the next few quarters to see if this strategy is really playing out?
Okay, 2 key things to watch. First, the Q3 price mix inflection.
Price mix inflection. break that down.
Sure. It's basically when the combination of price changes and the mix of products, so like selling more premium stuff or getting slightly better prices without losing volume, starts to look positive compared to the previous quarter. It shows they're getting more profitable per item sold. Very key.
Got it. More bang for their buck. And the second thing?
Confirmation that they can hit their adjusted free cash flow target. They're aiming for about $2 billion. Hitting that number would be strong validation that the strategy and the operational efficiencies are translating into real cash generation. Those are the big ones.
Okay, clear checkpoints. Right. It's time for our This Is Not Financial Advice segment. Pitch us an outrageous but plausible trade idea, hedge fund style. And remember, everyone, this is strictly for discussion, education.
Yeah.
Absolutely not a recommendation.
All right. Given everything we've talked about the Q2 results, the strategic shift, here's a thought. Consider a longer-term pair trade. Go long Kimberly Clark, and at the same time go short a basket of its more traditional price-led peers. Think, Procter Gamble, maybe Clorox.
Okay, long KC, short the classic staples players. What's the core thinking there?
The thesis is basically that Casey's success with this volume-led growth, driven by that value innovation, is fundamentally setting it apart now. While the peers might be struggling more with promotions or slower growth as consumers stay cautious, Casey is streamlining with that Suzano deal, focusing on better businesses, and seems to have found a way to drive volume.
So you're betting Casey's strategy is more durable in this environment?
And not just durable, but transformative. The idea includes Casey undergoing a re-rating, meaning the market starts valuing it more highly than it has historically.
Talk more about that re-rating and closing the valuation gap. What does that gap look like and why now for KC? And what could go wrong with this trade?
Well, historically, Casey often traded at a discount, a lower valuation multiple, compared to some peers seen as maybe higher growth or more diversified. It was often viewed as just a steady, defensive, maybe slower moving company. The rating idea is that as they prove out this strategy, shedding the lower margin tissue, showing consistent volume and margin improvement in their core personal care, the market might start seeing it less as just defensive and more as a growth at a reasonable price story within staples, maybe closing that valuation gap to the P&Gs of the world.
And the risks, the counter-arguments.
Biggest risk is execution, always. The Suzano divestiture needs to go smoothly. The consumer environment could worsen unexpectedly. Maybe competitors react more aggressively than anticipated to Casey's value push. If that innovation doesn't quite stick or gain the expected traction, then yeah, the re-rating thesis could stumble.
Makes sense.
But the current signs, the Q2 numbers, the strategy clarity, they suggest KC is really trying to transform from just cutting costs defensively to actually gaining share offensively. It's a bet that could be a real turnaround standout in what's generally a pretty slow growth sector.
A compelling, if definitely not guaranteed, narrative. Okay, that was our deep dive into Kimberly Clark. Key takeaways. Really impressive volume growth from that cascading feature strategy.
It's a big portfolio shift with the Suzano deal, aiming for higher margins.
And a raised outlook, helped by better tariffs, cost savings, and that divestiture accounting.
Yeah, it really highlights how, a clear strategy focused on essentials plus some smart innovation can drive growth and build a strong story, even when consumers are feeling the pinch. It shows big change isn't always about buying things. Sometimes it's about selling things to get more focused.
Absolutely. And remember, this information is purely for educational purposes. It should definitely not be taken as financial advice.
Always do your own thinking. Consider different angles.
If you have follow-up questions or ideas for other calls we should dive into, please reach out. The real insight often comes from asking not just what companies are doing, but why, and what that tells us about the bigger picture. Thanks for tuning in to the Deep Dive.